Good day. Thank you for joining me. I'm Ryan Kuhn and I'm going to be taking you through Sasol's half-year 2018 results.
Our recommendation. Sasol's results remain influenced by several external factors which have a significant impact on its profitability, such as the oil price and exchange rate movements. However, management has been able to influence costs and improve operating efficiencies during periods where operating conditions were unfavorable, negating the impact of low oil prices to a certain extent. Balance sheet strain is expected to be alleviated within 2 years upon the completion of LCCP, as the expansion capex currently being spent could be used to deleverage the balance sheet. It is anticipated that by financial year 2020, the LCCP project will provide a 9.8 billion rand EBITDA contribution. This should aid recovery of return on equity, which would align to its historic levels. A stronger balance sheet should also provide confidence that dividends can be sustained. Accordingly, we feel the investment proposition remains largely hinged on the success of the LCCP project. Oil prices are expected to stay between $62 and $71 per barrel over the next year, which will aid Sasol's profit and cash flow generation, while the company has hedged the downside risk. Trading at a PE of 10.8 times and a 1.2 times price to NAV, we feel the share is fairly valued. Therefore, we remain neutral on the counter at current levels. Looking at the Lake Charles Chemicals project. The Lake Charles Chemical Project is an ethane cracker producing up to 1.5 million tons per year, including 6 downstream chemical units, currently under construction in Louisiana, USA. This project is expected to add an additional 18 billion to Sasol's steady-state EBITDA. The project's total capex has been revised from 161 billion rand to a range of between 168 to 171 billion rand. LCCP's first production unit achieved beneficial operation in February 2019, while the various other startup units have been postponed for several months. The cracker is expected to achieve beneficial operations by July 2019, with 80% of LCCP capacity being operational by August 2019. Looking at a few financial highlights. Revenue increased by 17% to 103 billion for half year 2019. Brent crude rose by 14% and the ZAR USD currency weakened by 10% when compared to the previous period. These two factors are key drivers to Sasol's revenue line item. Higher prices were offset by lower than expected production and sales volumes due to the extended planned shutdown of the Secunda Synfuels operation and the force majeure at the European operation due to supply constraints. Headline earnings per share increased by 31% due to the rise in revenue and operating profits. The group has declared an interim dividend of 590 cents per share, an 18% increase from the prior period. Onto the cash flow analysis. Cash flow from operations increased by 121% due to the higher crude and exchange rate prices, as well as an increase in the cash received from customers. Maintenance capex rose by 36% for the period, caused by the planned shutdowns at SSO and the European operations. Expansion capex was down 6% from the previous period due to a decrease in expenditure of LCCP. Due to the large amounts of expansion capex, there have been large movements in debt in order to sustain the capex as well as the dividend payments. Looking at the balance sheet, there are concerns over financing. Sasol has taken on a significant amount of debt to cover the additional LCCP costs. If the full LCCP capex cash flow for full year 2019 expected of 30 billion is allocated to debt, the net debt to equity ratio would decrease by 1,300 bips to 32%. This would indicate the balance sheet quickly be deleveraged once LCCP is complete. Moving to prospects. Sasol has a continuous improvement program aimed at improving the robustness and competitiveness of the business. Management has set a target to increase the return on invested capital by 2% by 2022 off a June 2017 base of 9.7%. For full year 2019, management expects cash fixed costs to remain in line with inflation targets of 6%, CapEx is expected to come in at 52 billion for full year 19 and 30 billion for full year 20. Excluding LCCP, the company has several international growth prospects underway, which are expected to become beneficial operations between 2019 and 2020. These include a China ethoxylation plant, a Canadian shale gas asset, and other exploration objectives. If you would like to place a trade, please speak to your financial advisor or contact the trading desk. A comprehensive company analysis report on Sasol can be found on PSG Wealth's online trading platform. Before we end off, please take note of the following disclaimer. Thank you.